Hey there, back with another video. So here's another journal entry that we're going to record. This journal entry is not very complex, but it's more complex than any of the previous ones that I would have done because this is one that will involve a little bit more information and a little bit more thinking. Um, and so I just wanted to go through one of them with you as well. So let's just continue with the same fashion we did with the other videos. Let's look at the transaction and go through the steps to prepare our entry. Based on this transaction, it says that Brennan and Company purchased inventory and equipment from Jones Corp. The total inventory purchased was valued at $5,000 and equipment at $25,000. Brennan agreed to pay Jones at a later date for the items. So, what's happening here? One, what's happening in this transaction? So, it's pretty simple. They're purchasing something. So, Brennan Company is purchasing something from somebody else. What they're purchasing is inventory and equipment, and they're paying for it later. So, we can put that here, what's happening. The company is buying inventory and equipment they will pay later. And what paying later, another word for that is on credit. So they'll pay that balance at a later date. But they're getting this inventory and this equipment from Jones Corp. So that's a good way to describe what's happening. Next, we're going to ask what accounts are affected. So based on the transaction that's happening here, I would automatically know that there are more than two accounts affected here. Why? Because they already talk about inventory and equipment. We wouldn't put the two of those in the same account because they're two different things. They spell them out differently, so therefore that has to suggest that there are two different accounts, two different types of things. And so if we look on our listing, you can have an inventory account as well as you can create an account for equipment as well. And so that tells me that one of the accounts affected is going to be inventory and the next one is going to be equipment. So the company is receiving inventory and they're receiving equipment because they're purchasing it. What I will do, and I'll let you see my thought process as I go on with this. That's maybe the only thing that sticks out to somebody. So let's move on. How are the accounts affected? Well, we'll take our same inventory account and we'll say, how is inventory being affected by the transaction? We're purchasing more inventory, so that has to mean that our value has to increase. When we look at our inventory account based on the listing, what type of account is inventory? Well, inventory is considered to be an asset account because it's something that we can use to generate additional sales and therefore generate additional funds for the company. So that's definitely an asset. With inventory being an asset account, to increase it, that then means that we are expected to debit the account. This is just going off of information we would have already known. Equipment is the next account that we say is affected. Equipment. And what's happening with equipment? Well, similar to inventory, we are also increasing the equipment account. And so therefore we put that it's increasing. And because we're buying more equipment, so we are increasing the value of the equipment that the business owns. And then let's take a look and try to figure out, well, what type of account is an equipment account? Okay, your guess would be that equipment is also an asset account. Either you can look at the list or you can try to understand what equipment does for a business. Equipment is used to, most times it's used to help create a product or help to get something done so that you could either sell a product or provide a service. And so, similar to inventory, it's an asset account. And so, because it's an asset account, we're increasing it. And to increase an asset account, we should know that it's a debit. Now, if this was where you had gotten so far, you should notice that there's something wrong. So, already, there's something wrong. What's wrong is that based on the thought process that we should be developing with our journal entries, we have two debits. We do have the two accounts, but we have two debits. That means that this journal entry will never be complete. It won't be right. It may be partially correct, but it'll never be complete. Because if you remember, there's always a debit, there's always a credit. You can have two debits, two credits, two debits, one credit, two credits, one debit. It doesn't matter how many debits or how many credits, as long as there's at least one debit and at least one credit. And so this is already off because of that. And so if you ever come across a situation like that, then what you have to do is kind of go back and look at the question and try to understand what was missed. Something was missed in the question. It said that we purchased inventory and equipment from Jones Corp. Inventory was purchased and valued at that amount. They agreed to pay Jones at a later date. So they will pay later or on credit. Now, whenever you see on credit and we have to pay somebody later, what does that tell us? Ding, ding, ding. It's a liability account that's also affected. A liability is an account or a balance that we have to pay on at a later date, pretty much. And so therefore that means that there's some account that we missed, which is a liability account. So let's just insert this here. And if I just put a liability, no, I can't just put liability because that's a category. There's no account called liability. There are categories. There are accounts that fit in the category of liability, but no account that's called a liability. So we have to give this account a name. What normally happens when we're buying stuff from vendors, that's persons that sell things to us, are usually called vendors. We put them generally into an account called accounts payable. So accounts payable is actually the account that's for, like I say, whenever we're buying something from someone and we're paying them later, that's considered to be an accounts payable. When we're selling something to someone and they pay us later, then it's a receivable. It's an accounts receivable. So a payable means that we pay it later. A receivable means that we will receive the cash later. So that's also a good tip to know. Accounts payable would be the account that's affected. And so this part should be easy here. If we add that account, let's see if it does work out. How are this account affected? Let's add accounts payable. Oops. What happens with the accounts payable account? Well, this account should be affected by what? Is it an increase or is it a decrease? Well, if we think about it, that just means that we owe Jones Corp an additional amount later. So we're increasing the value that we owe to somebody. So accounts payable would therefore increase. We know that accounts payable is a liability account, and to increase a liability account is the exact opposite of increasing an asset, which means we have to credit. Now, is it possible that this is correct? It is possible because we do have more than two accounts, or at least two accounts. Yes, we met that criteria. And we also have debits and credits. Okay, so it's possible that this could be correct. We still can be off, but we're going to make sure that we balance ourselves off later on. All right, so let me just insert here. Since we have 3 accounts now, how much would each account be affected? So this is where you have to pay attention to what's happening in the transactions. In previous examples, it was straightforward, but this one involves 3 accounts and there's more information given. It says that inventory purchase was valued at $5,000. So that means that inventory can only increase by $5,000 because that's the only amount that we received. That's the value of inventory that we received. To put $25,000 would be incorrect because $25,000 is actually for equipment. That's the value of equipment that we now have. And so you can put equipment at $25,000 because that's the value of equipment that we now have. To put equipment at $5,000 would be incorrect. To put equipment or inventory at 25 plus 5, 30,000 would also be incorrect. So based on what the transaction tells us is how we know what to record and how much to record. Now we have our inventory, our equipment. Now let's go to our accounts payable, which we said we're increasing. So how do we know what to increase accounts payable by? Well, what we can do is we can say, well, accounts payable is a liability, something we have to pay to somebody, to Jones at a later time. How much do we really have to pay Jones? Because that's the value we need to increase the liability by. Based on the transaction up here, we purchased something for Jones for $5,000 and something for $25,000. So similar to when we go in a store and we pick up 2 items, when we add them together, we should know what we have to pay. And so we have to pay $5,000 plus $25,000, which is $30,000 back to Jones. So that means our accounts payable is supposed to increase by $30,000. And taking this information, let's take this information and let's record it now and put it in proper form. We don't have a date here, so let's just say on July 15th, Brennan Company purchase. Let's just put that there. Now, let's put our information together. Make it a little smaller. Perfect. So you can see everything. Okay. So let's put our information together by putting the journal entry together. It says on July 15th, that's when they purchased the inventory and the equipment on credit. And so therefore, the transaction date is going to be July 15th, 2020. Why? Because that's the date when we now have this inventory and when we agreed to pay Jones back. We came into an agreement for this liability. And so, July 15th, 2020. Account name, we can take that from the second one. So we have 3 accounts: inventory, equipment, and accounts payable. How do I know which ones to write first? Debits are at the top, followed by credits. Now, there are 2 debits here: inventory and equipment. It doesn't matter which one of them go first, as long as both of them are put before accounts payable. So I'll just keep it simple and I'll just put inventory, and we have equipment, and then followed by accounts payable. Now we should look at this and see that this is wrong because I actually need to take the indent off of equipment because that's not a credit. Accounts payable is the one that has the credit, so I need to put the indent there. And so this is correct. My 2 debit accounts are at the top. They're not indented. My 1 credit account is at the bottom and it is indented. Putting it together, We know inventory and equipment are debited. Inventory should be increased by the $5,000, the value of the new inventory we got. So debit of 5,000, and equipment should be debited by 25,000. And accounts payable is a credit, and a credit of 30,000. And so and then to give a description, bought inventory and equipment on credit. And that would be description that I could give it. And so essentially this is done. My journal entry is done. I can check it because I can note that I have at least one debit, at least one credit. And when I add up my two debits, I get 30,000. When I add up my one credit, it's 30,000. And so these are now imbalanced. They are balanced. Debits equal credits, and therefore I know that this is correct. And so this is just an example of when more than one account is affected and there are different numbers. It all pretty much should look the same. Sometimes in the real world, I can have a journal entry with multiple accounts, over 10 accounts in one journal entry, but once I understand what should happen to each of those accounts, should it increase, should it decrease, does it debit with an increase or does it credit with an increase, and then how much was the value that that account is supposed to increase or decrease by, then I can prepare a journal entry. And once I'm done, once my journal entry is balanced, then I know I'm pretty much there into being correct. Okay, and so this is just another example of the journal entry process on journal entry with that involves more than two accounts. If there are any questions, don't forget to post them and I'll answer them as soon as I'm able. Thanks.